As the death toll from the COVID-19 virus mounts and disruption to American society spreads, economic indicators signal that the crisis could be short-lived. The latest forecasts from the Wall Street Journal's monthly poll of 60 economists and the Federal Reserve Bank of Atlanta remained fairly positive, with stock prices falling well below long-term valuation and return norms. A snapback reversion to the mean grows more likely. The consensus forecast of economists surveyed in early March by the Wall Street Journal was for a sharp contraction in the second quarter of 2020, followed by a snapback to 2% growth in the last quarter of the year, a V-shaped contraction and recovery. Another sign that the virus crisis could be short-lived, the Atlanta Fed's algorithm measuring economic growth real-time as of March 6th indicated the U.S. is on track to grow by 3.1% in the first quarter, despite the economic cost of the virus. Meanwhile, stocks are sharply underperforming by historical standards. The S&P 500 has returned 9.6% over the past 28 years. Excluding dividends, that's a 7.4% average annual growth rate. This is consistent with returns dating back to 1871. The coronavirus bear market has knocked the returns well below the long-term trend line, which makes a reversion to the mean more likely. Finally, consider this. After trading at a high multiple only 3 weeks earlier, stocks are now priced below their historical norm. The red lines show a valuation range of stocks over the past 30 years. A high valuation, 19 times expected 12-month earnings, is in the upper red line, and the lower red line represents a low valuation range, when stocks trade at 16 times expected profits. The black line is currently well below the lower end of the valuation band, based on the latest earnings estimates. Historically, this indicated stocks were bargain priced. The Federal Reserve on March 3rd and again on March 15th cut lending rates sharply and announced decisive monetary measures to keep household credit flowing, anticipating some consumers would have a tough time staying current on their expenses. While no one can predict the future, these are real fundamental signs that the COVID-19 financial economic crisis could be short-lived.